Hi, and welcome to Future Focus, a financial strategies podcast where we make the complex simple. We're going to pick up on part 2 of our conversation, the retirement income puzzle. I'm joined here again by Jacob Messick.
Hey, Troy.
And Nolt Nicholson.
Hey, Troy.
All members of the Ameritas Advanced Planning team. So where we left off, we had talked about taxable, tax-deferred, tax-free, talked about the different vehicles. Now let's talk a little bit about application and kind of where we see the benefits of some of having assets in those, in those 3 buckets. So here's what we're going to do. I'm going to give you some common usages, and we're going to talk about it and kind of see where the taxable, tax-deferred, and tax-free kind of fits, and sort of where there can be some decisions that need to be made, and the art form is actually sort of sketched out on the canvas. Now I got a canvas with a puzzle on the way up the mountain, right? Okay, all right. So I want you to talk about the planning advantages, and I'm just going to sort of, we're going to rapid fire this, okay? RMDs. All right. RMDs. So what are RMDs? Required minimum distributions. This is the rule, the tax law, when it's, especially when you're dealing with qualified accounts. That says, hey, when you get to a certain age, it used to be 70 and a half for years and years and years. Now I believe it's 73.
73.
And it's does it go to 75 at some point?
Yeah.
I think it's like 10 years from now.
Yeah.
But yeah, it goes to 75. But anyway, it's the government's way of saying, we're not going to let you defer this forever. Now you've got to take money, and you've got to take at least a certain amount that's recalculated every year. So that's required minimum distributions. All right. So taxable, tax deferred, tax free. What's like when we're thinking about planning, how do we think about planning for RMDs?
Because I guess first off, I think we got to hit pause for a second on that. We need to take our mountain climber off to a little rest area because I can't believe Troy didn't even mention this at the beginning of the episode. Do you know what today is? Do you know what episode number this is, Noel?
I don't.
Troy, this is episode number 10.
This is 10?
I feel like that's a milestone that we need to mention. So for those that have listened, those that have listened to the first 9 that are hitting number 10, I think this is something we recognize. That
I tell you what, we will, because I think we should maybe even think about maybe taking some taking some questions. I tell you what, if you've been a loyal, dedicated listener and you've gotten to 10, why don't you send us a question, and we'll go ahead and answer it on the air for one of the upcoming episodes.
Oh, okay. I think that sounds like a good idea.
That work?
Sounds good.
All right.
Well, we had to mention that this was episode number 10 at some point. This is episode 10.
So, this is a big one.
I'm sorry. So now our mountain climber is done taking a little rest. He's back on the mountain.
But he has his canvas, his puzzle, and presumably everything else he needs to get to the top.
And he's just passing a sign that says RMDs.
All right.
It's a lot of work going up this mountainside here. No, I think a lot of it is first understanding what an RMD is, and you laid it out, I think, pretty well. That tax deferred doesn't mean you're never paying taxes. Taxes are coming due, and you get to a certain age where they come knocking saying, hey, taxes are due. And so money needs to start coming out of those accounts.
And you have to pay it. You don't get to choose what you get to pay. You have to pay a required minimum amount at least. And so it's determined already. Here's what you owe.
Correct. And so I think that goes back to kind of like we talked about the mix of different buckets, and just understanding that if you have a tax deferred bucket, well, you're paying taxes on that eventually. If you're taking it out voluntarily or not voluntarily, you're paying taxes on it eventually. So maybe that goes into your calculation 1 on how we're allocating. Oh no, let me go ahead and put that in there. How you're putting money into these various buckets.
I would have let you keep it out for allocating.
I would have probably let you go allocating, but there's probably something I let go earlier.
I mean, I use the word allocating in my daily life.
No, you don't. Anyway, I talk to you all the time. No, you don't use allocating in your daily life. Stop it.
I think that's fair. So anyway, I was just saying that it needs to be part of your calculation when you're looking at these 3 different buckets and how you're putting money in there, because part of the discussion might be, well, even if we know money has to come out of there, maybe we can utilize that for other purposes or have specific plans for those dollars coming out. Now, I'm not going to dive into that rabbit hole full on yet, but just that's broadly an RMD is something you need to be aware of for that particular bucket.
Anything to add?
No, I think you kind of described it well. I mean, tax deferred accounts, you're required to take RMDs.
Mm-hmm.
Tax-free accounts, you're not. So I mean that's, and when we're talking the advantage, when we're talking advantages,
Right.
That's one consideration to be aware of, and one advantage of having funds inside of the tax-free bucket is now you are not required to take it out if you don't need it or don't want to.
Right. Absolutely. Okay. Rapid fire. Liquidity needs and flexibility. How does taxable, tax deferred, tax free?
It really depends on what account you're talking about at what time. But the thing to know is that, let's say you've got a retirement account, and we talked about this a little bit on the prior episode. Let's say you're below 59 and a half and you're needing to access money. Depending on what kind of account you have, there might be additional taxes if you can even access it. So we need to have a conversation about, well, maybe we don't put all of our money in one vehicle, that the money is restricted in certain ways. Maybe we need to have different access to, let's say, a tax-free bucket in case some unknown expense comes up. We can access that without having to deplete other accounts that might have penalties associated with it. So I think when it comes to liquidity, you need to kind of keep that in mind too when you're putting money in each of these buckets.
Because even with the tax-free account, you still have the pre-59 and a half, the 10% that you
The
mentioned.
Roth has to be set up,
yeah.
at least 5 years now.
So I guess the Roth, you still have the ability to get to some.
Yeah. But with permanent life insurance, and we talked about, you have access through loans and withdrawals to those dollars. And I think you've kind of hit on, if you're before age 59 and a half and that extra tax penalty, if you get into the tax deferred account early, when I'm thinking, when you're in retirement, you're obviously managing your tax bracket at that point too. And so, if you're taking funds out of your taxable account, out of your tax deferred account, you may get to a point where any additional dollars you take out of there is going to bump you into a new tax bracket. And so
and we'll get the one where it's not just a new tax bracket. Well, I'll tell you what, I'll just jump down to it. It's not just a new tax bracket, See, this isn't fair. Like it's IRMA, and I actually don't know what the acronym actually means. I know it as IRMA. And so to your point,
if I
no, I'm putting it in there. Fine.
I look down at my notes from time to time only because there's just so much information to try to know, to try to make sure we have some definitions described. So
Right.
IRMA, income related monthly adjustment amount, is the definition of that for you.
Okay. All right. So that is a premium for Medicare, and it's income based in retirement. So to your point and your point, when we're talking about flexibility and we're talking about what those vehicles allow you to do, a taxable account, pulling money out, you're managing brackets. There's a bunch of things you said that leads to that IRMA sort of management as well. Because if I can have less taxable income in retirement, my IRMA premium for Medicare is actually smaller. And for some folks, that becomes a sizable number that I've got to build into a monthly budget as I'm thinking about what my retirement actually looks like. So, okay, another one. This actually is about IRMA, but how about Social Security?
It's the same sort of conversation, right? Your taxation of your Social Security benefit is going to be in part based on your income. And so if you have, let's say you're right up near a number where you're going to have a sizable increase in what your Social Security is taxed, well, maybe you have access to a tax-free bucket of money that can supplement your expenses and not have to recognize or look at that tax-deferred bucket for money that's going to go against your Social Security taxation. So it's the same sort of conversation we have with IRMA, that you got to be aware of what your income is and what counts as income for those calculations. And a lot of times these tax deferred buckets, they're going to count as income for IRMA, for Social Security taxation. And so you might want to have a tax-free bucket to pull from.
Yeah, it's funny because people defer, and like having that flexibility is so important. It's so important as we've seen in building all these other considerations that, frankly, when you were sitting down in your HR office and you're clicking off, I want to do this, and I want to put this amount of money in my retirement account. I'm going to get this match, and it's going to be whatever the number is going to be 30 years from now. You're not you need to be thinking about these other implications, and I just feel like so many people aren't necessarily thinking about those things.
Yeah, it's trying to think about those things as soon as you can, and then you're making adjustments along the way, so that way you're managing those buckets to on a regular basis, and that way if it is you're getting to a point where, hey, additional distributions coming out in retirement is going to bump me into a higher level that's going to impact me in these couple different ways. Wouldn't it be great to have some dollars sitting here that's not going to impact it?
Right.
Exactly. Well, and it goes back to that flexibility point that we keep hitting on, that these are the tax implications today. When we leave the room, the tax implications might be different. 20 years down the road, there might be another calculation. So it's just building in that flexibility to your overall plan is really the goal.
Right. So we've talked, planning advantages and why, and we sort of rapid fire some of the things, to consider as you're moving into retirement or you're in retirement. Now let's talk about, we'll call them, considerations or trade-offs or misunderstandings that can trip people up when they're chasing a retirement income strategy or they're trying to solve that retirement income puzzle. What are some of the things that we see people should be on the lookout for, or at least considering, and that could be misunderstandings or misconceptions about retirement income?
I think the first one, I'll tee this one up to you, is, it's, hey, this tax-free bucket, this sounds amazing. I want to put as much as possible into every type of vehicle, every type of vehicle or account that offers me the ability to take tax-free withdrawals in retirement. I want to fund an amount. I want to fund any amount possible.
Yeah. And we do come across that quite a bit, where I say, hey, I like the idea of not paying taxes. Let's do that one, which, it makes sense.
I guess we got to go down going down the list. Let's Roth IRAs first. To me, there you have income eligibility requirements that you have to be under, but then even if you're under the income to be able to contribute to a Roth IRA, there's still a maximum amount that you can contribute for each year.
Exactly. I mean, and each of these different items, even within the tax-free bucket, there are very specific rules, like you're saying, with a Roth IRA, a Roth 401k. We've got different rules. We've got different rules with life insurance. We touched on with the modified endowment contract. There's a lot of design elements for all of these, but even just more holistically, the idea of saying, let's put everything in that tax-free bucket. Well, maybe you're leaving an employer match on the table for no reason that you should be taking advantage of. So doing kind of everything in one bucket, you need to probably pause and look at the full picture to see if that makes sense.
See, that's where I'm at, right? Like I definitely, as much as, if you look at if you haven't seen episode 9 or the first part of this conversation, I'm a big believer in tax-free income, but I'm not a big believer in all, right? Whenever something is preceded with all, I'm going to pause, and I'm going to sort of pull back and try to, and like all the time, I should never do anything different. There's never considerations for something that may not fit. I mean, this works all the time. I just to me,
that's the law school in you.
Exactly. I just take a step back. That's the like that's the philosophy. Yeah. Like I'm going, well, that's just a basic syllogism. Like okay, sorry, syllogism. That's just a basic sort of logic sort of thing. Like anytime, because all I got to do is find one thing that it's not the case, and then that argument's just is blown out of the water.
Yeah. For example, you're in a high tax bracket, your working years. you may be in a lower tax bracket in retirement. So it may make sense to defer, fund the 401k, not the Roth 401k while you're working, while you're in a high tax bracket.
Right.
And then maybe, do something like a Roth conversion. We'll just, later on down the road when you're
A Roth conversion is what? I mean, I think it's self-explanatory, but
so you were pretty much saying, hey, I want to take these tax deferred dollars and I want to convert them to Roth dollars at some point. And you can do a full or partial. Maybe this is an episode that we talk about. We spend some time talking about episode 11 or 12. A little bit more on Roth conversions as a whole. But that's pretty much it. You're just moving those tax deferred dollars to tax free dollars at some point.
And the consideration there is you're paying the tax.
Yeah.
Like the tax man always coming.
Yep. Yeah, it's coming down the road, but you volunteered to pay him earlier.
So that's where you have to make. So that's where, like, let's say you've built up $1 million in a tax deferred bucket.
Ooh. We got to talk about something.
But let's say you have $1 million, and you go to convert that full $1 million. Well, you're going to be taxed on that full $1 million. That may jump you up into a very large tax bracket.
Right.
So it may make sense to say, hey, maybe I convert 100,000 over 10 years or 200,000 over 5 years, something, but that's where we're working with a financial professional. We'll preface this with, this is just general information. Again, like always, general information, not specific advice, but working with a financial professional may help to see for your situation, does it make sense to do some level of a Roth conversion if you have a large tax deferred bucket?
Right.
And I guess, do we want to, I know you guys have the law background. I have the numbers background. Do we want to, we were talking about funding consideration for those tax-free vehicles. Do we want to throw out what some of those max contribution numbers are at all?
Do we want to, well, I'm at a loss for what you're actually talking about right now. Like truly.
Okay. So, for example, Roth IRA, Troy, let's say you wanted to fund a Roth IRA this year.
Contribution limits.
Contribution limits.
Okay. I believe it's $7,000.
Yep.
Yeah,
So
there we go.
And
There
so
we go.
so it gets indexed.
Score one for Troy.
Well, for what age though?
Well, that's the thing. If we're doing the extra,
and then there's a catch-up provision.
So maybe we should spend just so this is some. We'll go 60 seconds of numbers here. So you had mentioned Roth IRA 2025. You can contribute $7,000 if you are under the age of 50. If you are 50 and over, you can do a catch-up contribution. It's an extra $1,000.
It's $1,000.
So it's $8,000.
$8,000.
So 8 for ages 50 and above.
Right.
So that's Roth IRA. We're talking Roth 401k. Here's a few more numbers for us.
It's 23.
23,500 if you're under age 50. Now, if you're 50 and above, like our friend Troy, you can put in an extra 7,500. So you can do a total of 31,000 into a Roth 401k. And then we have our friend, the Mr. HSA, the health savings account. You have to have a high deductible savings account.
And that a high deductible savings account, but then that actually varies between single and married, correct?
Yep.
It's technically called individual and families, but single to married, I guess.
Single to married for us older folk when the code was written on a stone tablet.
So you got 4,300 for 2025 for individual. 88,350 for families. There is a 1,000 catch up for ages 55 and above for that. So, Roth IRA, Roth 401k.
I'm not the catch up level yet. So
I was gonna say I went to law school for a reason. So I'm glad you brought those numbers in.
So those are some. So I mean, when we talk about funding considerations, there are maximums if you qualify. If you are able to fund dollars into these plans, there are limits. Those were the limits.
So back to misunderstandings and sort of misconceptions. Is there anything else? Like if someone said, well, what's the limit on life insurance? What would you say?
Well, I would say it's going to depend on a number of different factors, but like we talked about with how you're funding it can be a limit depending on what death benefit you're looking for that modified endowment contract issue. We could also have an issue on the back end where, let's say you were taking too much money out and the policy lapses. Mm-hmm. Well,
don't want that.
We don't want that either. So we could have tax coming on that end. And so I would say just looking at life insurance, you need to make sure it's properly designed out of the gate and that you're maintaining it to make sure you have that tax-free status still on that policy and you don't trigger any other rules. And there's a lot of other ways you can do it, depending on who owns the policy, what's happened with the policy throughout the life of it. So it's something you need to pay attention to.
How would you?
No, I think you described it well where you didn't have to throw anything in the jar. I mean, I think it's, the biggest thing the limits come from is, what's the death benefit of the life insurance policy? And based off that death benefit, there's a maximum amount of premium that could go into the life policy to keep it from becoming a modified endowment contract, a MEC. So there is premium constraints in permanent life insurance as well too. Mm-hmm. And so, I think kind of you described it well.
Yeah, it's interesting. Just everything. Again, if we bring this conversation full circle, everything has its place, and sometimes it just depends on how you squint and what's most important to you, and whether or not you incorporate something or not. But definitely incorporating taxable, tax-deferred, and tax-free buckets allows you to gives you more pieces of a puzzle to put together. Is there something that you wish I would have asked? Something that you wanna hey, Troy, make sure we talk about, or at least I have a thought about this.
The one thing I'll add is that changing your retirement plan is not a bad thing. Life changes, your plans change, and so if you're, let's say, 5 years into retirement and your entire plan has changed for whatever, maybe it's personal reasons, financial reasons, name the reason, right? That's not a bad thing. You just have to build that flexibility into the plan. And like we've talked about, and I think we've nailed this pretty excessively, you're at base camp, putting your backpack on, you're getting ready to hike up, start putting those puzzle pieces, start putting everything you need in there so that when you're coming down the mountain, you've got what you need when things change, because they will change. And so I think that's okay, that people know that their retirement plan is going to change. Your life insurance policy is going to change. Maybe you had it for one purpose and you're going to use it for a completely different purpose. That's okay. You just have to keep revisiting it and make sure it's on track for what your needs are.
Top that finish.
I don't think I can. I think it just is review your plan, review it often, and know that you can, the earlier start, the more flexibility you have to make changes along the way. Nothing is a one size fits all. Mm-hmm. Things are going to look differently, for everyone. Retirement for me is going to look different than it is for you, then it is going to look different than Troy. And so it's just, but if you have proper planning and proper design and, start, planning early, you have flexibility in the approach, and, building funds in all three buckets give you that potential to make those changes along the way.
Exactly.
Well, I would say don't chase tax-free, the idea of tax-free income blindly. Having flexibility allows you to do a lot of things that people want to do in retirement, which is spend more of their dollars, pay less in taxes.
I think there's benefits of all three buckets. There's benefits of tax-deferred, tax-free, and taxable. And so, so there's benefit, there's advantages and considerations of all of them. So it's just being aware of how each one act. And that way you're able to manage those and be able to get to the result you want to get to. Absolutely.
Anything else?
I'm just really proud of us as far as the jargon jar, but that's the only comment I had.
That's good work right there. That's a lot. That's a lot. That might be a record. We'll have to count that up and put down the record somewhere. Thanks everyone. Appreciate your time and attention. I'm Troy Branch. This is Future Focus, a financial strategies podcast where we make the complex simple. Thank you for your time and attention. Look forward to seeing you in the next episode.